Hey everybody, good afternoon. Marty Mazora, 26th of July, 2016, your Tuesday video commentary. Well, it's a big week. It's a big week for earnings. The Fed is meeting today and tomorrow. Expect nothing in terms of a rate change. Expect dovish language, despite the fact that economic data has been coming in a little better than expected here of late. In fact, in some cases, a lot better. And the Bank of Japan meets this week. I'm going to be very interested in that. The Bank of Japan or I should say, Japan itself has struggled under the weight of a very strong yen of late, and we'll see if the Bank of Japan is willing to step out and do something about that. So in today's presentation, I want to have a little fun and talk about the factors that make the market possible. And really what they are, or what it is, folks, is you got to have dissenting opinions. Never forget that there has to be a buyer and a seller, individual or entity, to make the market work. It's an auction. So two entities or two people agree on a buying and selling price, which means these two entities or people have to, at that moment, think differently about the forward prospects for whatever it is they are transacting. My first example is going to be with regard to Apple. So here you'll have two, I'm sure, quite gifted, very intelligent analysts who, for whatever reasons, they both have, the same data at their disposal, but they are people, they're human beings. And as I suggested in last week's commentary, they've got their own stuff going on, regardless of their talents and their academic accomplishments. Therefore, they are going to think differently, or at least these two do, about one of the world's most important companies, and that would be Apple, who announced earnings this afternoon. So take a listen.
Joining us is Brian White, Global Head of Technology at Drexel Hamilton. He's a bit bullish on Apple, and Sherry Scribner is Technology Analyst at Deutsche Bank, a bit more cautious. Brian, you seem to think that the iPhone 7 will be a catalyst for growth and better comparisons, and Sherry, you're not convinced of that.
But the problem is that the worldwide smartphone numbers are starting to slow pretty significantly. Phones are expensive. The iPhone is a very expensive phone.
Brian, you still have a $185 target on Apple, correct?
Exactly.
So you're looking at basically a double, not quite, but almost a double. You've got a lot of negativity. You've got the iPhone cycle, the sales cycle, the profit cycle, all bottom in the June quarter. Negative sentiment is very, very negative.
So I want to just jump in here for a second and make note of the gentleman's comment that sentiment is very, very negative, and therefore he's very, very positive on Apple stock. You may recall over the last few weeks, I pointed out that sentiment, and that would be overall market sentiment, was very negative coming into the Brexit vote. And that little washout we had from Brexit, and then the realization thereafter that the world was still spinning, was what allowed all that negativity, therefore all that cash, to come back into the market and push us to new highs. So clearly my experience and maybe my personality makes me sympathetic to the gentleman's case. As for the other analyst, she doesn't seem to believe that negativity going into what I believe to be a strong fundamental situation is a good thing, or she doesn't believe in the fundamentals. She would prefer, and I certainly respect her position, to leverage a statistic that says companies that make up a large portion of the S&P 500 tend to trade at lower priced earnings multiples than you might otherwise expect them to.
Last word to you, your price target is $80 lower than his.
Large companies that are more than 3% of the S&P 500 traded discount to the market.
Well, as it turns out this afternoon, the gentleman, I suspect, is feeling very good about his firm's position on Apple. And I suspect the other analyst that her firm, based on Apple's results, which were surprisingly good, and the commentary of CEO Tim Cook, probably should be rethinking their position on Apple going forward.
Apple reporting EPS of $1.42, Kelly. The street was at $1.38. Revenue of 42.4 versus expectations of 42.1. Gross margin of 38%. iPhone units 40.4 million, Kelly, versus expectations of 40 million. iPad at 10 million. That's the first time in 10 quarters, actually, you've seen revenue growth there in the iPad. Mac, 4.3 million. Other products category, Kelly, remember that includes the watch. Revenue there of 2.2 billion. Services at 6 billion. That was a 19% pop. Cook telling me he expects services to be the size of a Fortune 100 company by next year.
So let's have the same exercise on the overall market. The first analyst you're going to see here in a second is Tom Lee. He's been very bullish for quite some time on stocks, so he's looking pretty smart right about now. Although he's a bit cautious about August, and it's more of a seasonality play. He talks about how August has been a tough place to be of late, but in the end, he sees as much as 8%, I think he says at least, for the market between now and the end of the year.
Tom, what do you think is in store for us for the stock market? We're heading into this period, August. August scares us because, the last 7 years we've seen some big drawdowns. 4 out of the 6 have been huge, but on average, you're down 6% at some point in the month. I think it's setting up for August to be pretty scary. I mean, for the vast majority of your viewers, I don't think they should do anything because, a 2 to 3% sell-off isn't enough to really warrant a big shift in a portfolio. Between now and year end, I still think we're 8%, at least 8% higher.
So now let's listen to the other side of the trade. This would be Carter Worth, a very good technical analyst who I sense a little frustration in Carter. I think that the market of late has not been supporting the positions he's been taking or suggesting people should take. He talks about how for the last couple of years at least, the market really hasn't delivered virtually anything, certainly not relative to the risk one takes in the market, and appears, in my view, to suffer from some recency bias. Not that his charts aren't telling him the story he's suggesting, but he's not suggesting that things change and things evolve and that things revert to the mean and that maybe stocks are overdue for a period of outperformance.
Is that the smartboard breaking down all the charts? Hey, Carter.
Hi there. So I have a bunch of charts, but I think the issue here is that we know on an absolute basis, one has nothing to show for having been in the market now since May of a year ago. You've got the market. Now, if you adjust for risk, this is almost the worst performing asset, even prospectively below crude or Apple, because crude has a high beta. So the issue is, just because you make a new high, has something changed? You'll notice people get very bullish at highs. They get bearish at lows. But nothing's happened now for 1, 2, and in fact, a very long time. This is not ideal. So, yes, we stuck our head up there. Did anything change? We would have to go meaningfully higher to start to compensate for the risk that's been associated with owning equities, not only in the past 18 months, but for quite some time. And there's always the risk that you do that, or it's that, or, and this is what the bulls are hoping, that somehow we're going on a new bull phase that's meaningful. Maybe so, but I doubt it.
So here's where Mr. Worth was shooting that video, and he suggested that he really didn't hold out a lot of hope that the market was going to move meaningfully higher than that point there. So let's just fast forward to today. That was roughly a couple of weeks ago when that video was shot. And as you can see, right now it did move meaningfully higher, and now clearly we're in a short-term, from about the 14th, real sideways pattern. I think that's a positive, having moved through some very strong resistance that's been there for over a year, and then to stay above that and maybe to consolidate, move sideways for a while. Mr. Lee actually expects to, during the course of August, to very easily test this 2100 level before moving forward to those greater all-time highs between now and the end of the year. Bottom line is, folks, those two gents, just like the man and the woman who debated the Apple story, neither one really knows. Everybody's looking at the same data. Some people are looking at the more technical picture versus the fundamental picture. I've told you my analysis of the market is that while I don't know where we go from here, the setup for the rest of the year looks better to me than the setup for the market has been for quite some time. Lots can happen. It is an election year. It's going to be very interesting. And of course, I'm going to be here the whole way, twice a week on average, talking about what's going on. As for this week, this is pretty much it for me in terms of the videos. After tomorrow, I'll be gone until midweek next week. So if I do have an opportunity to shoot in something over the weekend from a remote location, I'll try to do that. There is the Fed meeting, there is the BOJ meeting. These things could be market moving, but we're not short-term investors, so I don't suspect there would be. In fact, I'm positive there'll be nothing that I see happening this week that would be worth reacting to, unless, of course, we're just super heavy on brand new cash and we have some money to allocate. Then, of course, we may find an opportunity and a reason to come in, and that's a portfolio by portfolio decision. But for us patient long-term investors, this is just the stuff that is the nature of the market, always has been, always will be. And again, I'll look forward to helping you put the short term in perspective, but always reminding you to think long term. Have a great rest of the week, and I'll talk to you very soon. Bye-bye.